Canadians to purchase real estate in the U.S. However, real estate is subject to a few complex tax laws, whether it's in Canada or in the U.S. Evans Martin LLP has expertise in this area and can provide advice on structuring holding, as well as minimizing income and capital gains tax. Planning is required to eliminate exposure to U.S. estate tax for Canadians who own U.S. real estate outright. Both rental income and capital gains can be subject to taxation in the U.S. and in Canada. Some basic knowledge, as well as the advice of an experienced tax consultant, is important. And that's why we've asked for us tonight to have Paul Howlett, who's a partner with Evans Martin, to give us some tax advice. Paul?
I'd like to thank you for inviting me and everybody on the panel as well. And first of all, you've asked me to, Linda, be funny and not to scare anyone. Now that's a tall order for an accountant, but we'll try our best here. What I want to do is, it's okay, blinded by the light. What I wanted to do, Steve, if you can start going there, was to give you a number of forms of ownership that you could consider, and Jay mentioned a number of them. This one, Steve. And first of all, I think you need to have a little primer on U.S. Income tax. And so, for example, if you're going to rent out your Florida vacation property or your Baker real estate vacation property, is that okay? Yeah. Now, because the IRS does not know you, the tenant that you're going to be renting out to is required by law to withhold 30% of the actual gross rental income that you otherwise would receive. And, you know, that 30% can be a large number. So you always want to engage yourself with professionals down there and up here who can file tax returns for you. First thing you need to do is to get individual taxpayer's identification number. And we just happen in Canada, in our office, to have a certified agent to enable you to get an ITIN. That will enable you to file a U.S. tax return and enable you to fill out a number of forms. You need a professional as you go along the way. You can reduce that withholdings and possibly even eliminate it. Okay? You're going to be calculating your tax on your net income that way instead of 30% of the gross, big difference. And you'll be able to get that tax if it happens to have been withheld in the first place. You'll be able to get it back. You're going to pay tax on the net rental income in the States, and the tax that you pay can be used as a credit against the tax that you'll have to pay in Canada because you're a Canadian resident and you're going to be paying tax in Canada. So there's a treaty involved there that is there to make sure that there's no double taxation. Okay. This slide deals with, well, what happens if you do sell your lovely Baker real estate vacation property. And the same thing, the IRS does not know who you are, so the purchaser this time is required by law to withhold 10% of the gross proceeds. So $1 million sale, $100,000 goes to IRS. They withhold it and they send it to IRS. If you engage one of my brethren in the States, and actually some lawyers do it, I should say. I've seen some lawyers are able to do that, yes, which is to file a withholding certificate to either reduce or eliminate sometimes the actual withholding, and that entails you getting a taxpayer identification number, filing a tax return, and tax on a net basis and being able to either get a credit for that 10% withholding tax or to get it back outright. You've got to watch, obviously, exchange rates. You know, if you hold the property for a long time, there may be more of a gain than you may think, or a loss. So you have to be cognizant of that. As far as tax rates go, in Florida personally, you'll be taxed at 15%. That's the federal rate. For trusts, the beneficiaries of trusts are also taxed at 15%. Same for partnerships. Now, if you happen to have held the lovely vacation property in a corporation, the tax rate is 35%. Obviously, not something that you want to deal with. There may be some other reasons that you want to use the corporate form. There is also the other form of taxation, which really is a wealth tax, which is the estate tax, and Jason referred to that. Steve, go to the next, and here we have it. If you died in 2010, that's when you wanted to die, okay? Because you wouldn't have paid any tax. And actually, if you are going to be paying it, you're dead, so you probably don't care. But I tell you, it's your heirs and your beneficiaries are the ones who are going to care. So it behooves you to do something to make sure that you're leaving the less of a burden on your beneficiaries than you might otherwise have. If you look at that chart there, you can see, again, 2011, 2012, yes, we have this $5 million exemption, okay? 2013 and afterwards, who knows where it'll go? I know in 2009, that $5 million exemption was $3 million, and I've actually seen it as low as $600,000, which is a pretty low number, okay? So don't just look at the fact that, well, it's $5 million now, boom, I should be safe. You know, I think we have to look to the future, and undoubtedly we know that every country, I dare say the U.S. more, is looking for money, tax dollars, so I can't see that $5 million number staying for too long. And as a matter of fact, just to explain that, if somebody's going to be, someone may see this kind of a chart elsewhere, you'll see that the actual exemption rate is $5 million, the unified credit of $1,730,000. That is actually the tax on the $5 million. And that is a credit that if you were a U.S. resident, you would be able to get the first $5 million tax-free. However, us as Canadians, what they do is they say, okay, if your estate is over $5 million, you very well may be paying U.S. estate tax. And that credit of $1,730,000 is not necessarily going to be all yours. We're going to prorate it for you Canadians, meaning that if, actually you can go to the next slide, Steve, here's an example where if you have your U.S. estate, let's say it's $1 million, relative to your total worldwide estate, it's $10 million. So you, in effect, will only get, and you can just look down a little bit there, you're only going to get 1/10 of that unified credit. So the actual tax, when you go and calculate it, is $330,000. You're able to get part of the unified credit, but in the ratio of this U.S. assets to your total worldwide assets, you've only got a credit of $172,000, and you end up paying U.S. estate tax. Okay, so, and this is at a $5 million exemption rate, which may not hold. And I can't see it basically holding. So Steve, the next one, please. So what we do as accountants is try to mitigate that tax somehow, give you ways of being able to reduce it for you. First of all, the easy one is if you leave the vacation property to your spouse, you're able to, in effect, double up on that unified credit. I showed you, if you flip back, Steve, just one, see that $173,000. If you left the property to your spouse, then you get double that $173,000 credit. In fact, in this case, eliminating the estate tax. Step forward again. However, that is really only a deferral, because now the surviving spouse is left with the entire property on her own with only one credit, and she also has to deal with probate. And you may see, you also see where I say watch probate, it avoids probate on the initial transfer of the property to your spouse on the first transfer. You say, well, you know, what's this probate thing? Well, probate, I believe, is about 3%, is that right, in Florida? I think it is. You know, on $1 million, that's $30,000. And in addition to that, probate is something that, I'm getting a little vibe here because I may be scaring you. This deal with probate is that it may take a long time, and I've actually seen it take up to a year, which, you know, unfortunately, but that's true. But there are also ways of being able to mitigate that by making sure the professionals that you're using are you know, top-notch and are up on how to avoid those situations. One of the other ways that we can reduce our U.S. estate tax is by insurance. But again, you know, it has its drawbacks. You still don't avoid probate. You've got to be paying premiums, and the insurance that you get is also added to the total U.S. assets to your U.S. base. So it increases your assets that are otherwise going to be subject to U.S. estate tax. One other option is what we call a non-recourse loan. A non-recourse loan is where the lender or the mortgagee's only recourse really is against the property itself, as opposed to up here, and correct me if I'm wrong, Jason, up here the lender's recourse can be both to the property and to the individual mortgagee. So you have to be wary of that, and I believe you can borrow up to 60% of value of the property, and what this does, it reduces dollar for dollar the value of that vacation property, thereby giving you a lower amount to be included in the calculation for your U.S. estate tax. So that's a possibility. Again, you've got to watch probate because you're going to be still subject to probate using that. Jason talked about joint tenancy, where the survivor gets the entire property. That's a possibility as well. That avoids probate, but the IRS takes the position that the entire fair market value of the first to die in this case, it's included in that individual's income, regardless of whether or not there was an equal contribution to the purchase of the property. A better way of doing it, Steve, go ahead, is what we call tenants in common. That is where you have an undivided interest in the property, so husband and wife could own it, or husband and a child, they would own an undivided interest in that property. And what that does is it splits the value of the property itself. Again, reducing the value for an individual, and therefore that amount is a reduced amount that would be included in the calculation for the estate tax. You should also consider, your accountant will bring up, okay, well, if the whole goal is to reduce the value of your U.S. Citus assets, then maybe we can do some planning for that. Sell your U.S. stocks, which otherwise would be subject to that estate tax. And I've seen a number of clients actually sell their property, as they were getting on in age, and rent. So, I mean, if you rent, you're not going to be subject to U.S. estate tax. That's simple. Next slide, Steve. We talked about, Jason did, you can use a corporation. I wouldn't use a U.S. corporation unless it was owned by a Canadian corporation, because a U.S. corporation, you're going to be subject to the U.S. estate tax. Okay? As for a Canadian corporation, it does avoid U.S. estate tax, but I would only use it if it was principally a rental property. And the reason being is that if it was just a vacation property where you and your family use, you're going to be subject to what we call imputed income for personal use. Now, if it was held through a corporation that was incorporated prior to 1995, that was okay back then. You can't use that tax avoidance way anymore. Okay, so these two are not any of my favorite ways, but this is the gold standard. Okay, Jason talked about this as well, being the ownership through Canadian Discretionary Family Trust. Okay, it's a very technical thing actually, but what it does is it avoids U.S. estate tax, it avoids probate, it avoids annual filing that otherwise would occur with the corporate form. Okay. There are only two drawbacks. One is that, well, let me give you the typical scenario is father creates a trust and contributes money to the trust to purchase your Baker Real Estate vacation property that's in the trust now. And for that, he has to, in effect, relinquish any use or ownership. He is able to use the property only by virtue of being married to a spouse that is a beneficiary. So you've got this trust where dad settled it, he's the grantor, he's the settlor, and the beneficiaries would be spouse and the kids. So what you have done in this sense is you've done some proper estate planning. You've reduced the potential for, or eliminated the potential for U.S. estate tax. You've avoided probate, no annual filing fees. It is what I call the gold standard. But there are some very sort of strict rules that you need to follow. And Steve, if you want the next slide here, you've got to ensure that the name is going to be in, the title is taken in the name of the trustees sign everything, there's a proper U.S. bank account, trust is settled by cash, and it should be cash that's contributed up here. Beneficiaries can pay expenses, capital improvements must be made by the trust itself, and the beneficiaries can contribute to the trust. Actually, the flip back one is the other little, I consider the little inconvenience is the fact that the 21-year rule. And there's a deemed disposition after 21 years. You say, what the hell is he talking about? Well, because of the rules that are concerned with trusts in Canada, the assets of the trust, in this case, the vacation property is going to be deemed to be disposed at fair market value, and there could be capital gains that could occur. So you're looking at maybe a 21-year horizon for this.
Exactly.
But there are there are certainly ways around that, and I didn't need Jason to tell me that. But thanks for the
It
prompt.
allows for lawyers and accountants to make money every 21 years.
Yeah, we do. We do a lot of tag team stuff, actually. But that's for another day. Very true. So, still, I covered the whole standard. If you go to the next slide, yes, it is possible. You might see ownership forms in a Canadian partnership, but for a partnership to happen, you need to have an actual business type motive, a profit motive. Maybe you're going to be owning property with others who are not relatives, and so that's a possibility. You might consider a limited partnership if you're concerned about legal liability. If I can leave you with anything, it is that there is no substitute for professional advice, and thank you.